Well, welcome back to Finance Uncut. On today's episode, are we heading for a currency collapse? Before we get into the video, I just had to share this breaking news because I'm not seeing anybody talking about this. But the Indonesian government is to launch a blockchain based precious metals backed payments and savings platform outside the banking system. Um, the third most populous nation on the planet. Now, I've got a lot of Indonesian friends and they know gold and silver. They have known for a long time not to trust government, and they save in gold and silver. So shout out to my friend Siska. They understand it. They understand it, and so this is big news that I'm not hearing anybody talking about. And the Fed and people in the media saying that this inflation that we're seeing is just transitory. The deflationists, even though they're saying we've got deflation, occasionally admit, oh yeah, we do have inflation, but it's transitory, and then we're going straight down into deflation. But this video, you're going to see that not many people believe in that. I thought I'd share this. So gold is back above its 200-day moving average, while the US dollar has tried to rally but failed. So I'm looking at over the coming 6 to 12 months in particular. I think the US dollar. Look, I hear Brent Johnson, the dollar milkshake theory, and there's some validity in it. And so I've got a small hedge that if his thesis plays out, that I will benefit. However, he actually thinks the dollar and gold can rise at the same time, and we have seen that before. But I think the more likely option is that the US dollar over the next 6 to 12 months actually falls, which I think will be bullish for gold and silver as well. So I'm obviously leaning more that way with my position, but I do acknowledge Brent Johnson's dollar milkshake theory, and I do have a small hedge for that to play out. And if it doesn't matter. I win anyway. So this is something I'm keeping an eye on over the next 6 to 12 months. Now, economists who said inflation was dead now thinks it's alive. Roger Boodle. Let's have a quick look at this little article, because once again, all the deflationists, well, not all, but most of the deflationists who have been deflationists for 20 or 30 years are now jumping ship because they've seen that we've crossed the Rubicon. I've done videos in the last couple of weeks where I've shared that we've crossed that Rubicon, that we've gone from a monetary dominant policy to fiscal dominance and MMT. So Boodle was the founder of Capital Economics and author of the 1996 book, The Death of Inflation. Back then, he argued decades of consistently high rates had come to an end. While he doesn't yet see a return to that era, in an interview with Bloomberg on the 2nd of June, Boodle argued the world is on the cusp of another turning point. In the 1990s, you identified the start of a new era for inflation. Do you think this is the start for another sea change? Roger Boodle said that it is the start of a sea change. I have to say, that's not to say that we're going back to the strong inflationary conditions of the 70s and early 80s, but at the very least, I think we're at the end of the crypto deflationary period that we've been in for the last few years. He says, and this is a key thing, the danger of deflation has passed and the risks have definitely tilted in the other direction. How high inflation will go and for how long, that's debatable, but I'm not in much doubt myself that there's been a sea change. So here's the guy who wrote the book Inflation is Dead back in 96, has now changed ship and jumped ship and said that the danger of deflation has passed, that there's been a sea change. The debate now is just how high inflation will go. And you know, some of you will know that Dr. Michael Burry and Professor Richard Werner are saying that we're going to have hyperinflation by 2023. They've actually put a date on it, a timeline, and that's what they think. Others say we're going to have 70s style stagflation. At this point, I think Lynn Alden is probably more on the money with the 1940s style inflation. So we get these big inflationary spikes, where inflation, I think it was 1946, inflation hit 19.65% or something like that, while interest rates were kept extremely low. So anyone that held bonds got destroyed during that period. But basically we're very similar situation to where we are now on a macro and a debt position. So that's what I think. And Deutsche Bank warns of global time bomb coming due to rising inflation. In an out of consensus forecast, Deutsche Bank is warning of a potential crisis coming from inflation. The effects could be devastating, particularly for the most vulnerable in society. And most on Wall Street and at the Fed see inflation as a temporary problem that will ebb as special factors fade away. Now, I am not a big fan of Deutsche Bank. However, they are 100% correct on this. They are also seeing that the sea changes, the tide has changed, that the Rubicon has been crossed, and so let's cut to a clip and see what actually Deutsche Bank are saying about this.
I mean, I think the inflation debate divides everybody at the moment, and within DB Research, we're no different. There are some people who don't think inflation is a big issue, and there's a few of us who think it is a big issue. So we just want to raise the debate and get some kind of intellectual diversity about it. I think for those that do believe in inflation, we think the economic orthodoxy is changing. And in the note, we talk about the big contrast between 40 years ago when, Volcker was just put in place at the Fed to combat inflation, and everything was very, very tight on the monetary side. And at the same time, Reagan was elected with a mandate to reduce big government. And if you look 40 years on today, we've got a Biden administration who is putting government at the heart of the economy and rebuilding the economy, so masses of fiscal spending. And you've got a Fed that has just embraced average inflation targeting and now wants to see actual gains in employment and wants to see inflation go a little bit above target rather than kind of lean against it. So, this orthodoxy, I think, is changing. And it has changed since the financial crisis as well. If you go back a decade ago after the financial crisis, we very quickly hit the sovereign crisis in peripheral Europe and the Greek default. Reinhardt and Rogoff wrote the seminal work on how much debt you could survive with as a government. And that scared every government, and we had a decade of fiscal austerity. Now, I think that austerity, there was cracks appearing in it before the pandemic, but the pandemic has kind of blown it out of the water. And now we have far, far more higher levels of debt than we had when the sovereign crisis was ongoing. And yet no serious commentator is talking about default risk as a possibility. And, governments around the world are saying we can spend more, we can give the population a bit more of what they want. And at the same time, the central banks seem to be supporting that. So we think the economic orthodoxy is changing, and that's the reason inflation will be higher in our view.
It's really interesting to hear you emphasize the central role government is taking here, and how policy is changing, and how government is really at the center of this potential inflation comeback. If we do see inflation return in full force, what does that mean for government's new policy goals like climate change and other sort of social norms that they've put at the center of their policy now?
Yeah, well, I think the move to put social policy at the centre is extremely admirable and shouldn't be criticised. That's the one thing you would say. But I suppose the risk would be that if you did see inflation, it might make macroeconomic policy much more challenging. And if central banks did raise rates aggressively, it might reduce the ability to address all these social issues. So I think as a minimum, policy making is about to get a lot more challenging if you get inflation.
I had a look through your report, and there's one chart in particular that stood out to me. It's a chart that a lot of the crypto community like to circulate, and that is the one of money supply. I believe it's figure 4 in your report for anyone who's watching this. And it does show that money supply has seen an explosive growth over the last couple of years as a response to the pandemic. And even if you compare that to 2008 doesn't even register on the scale of how much money supply has actually been created just in the last 12 months. But isn't it also true that in order for this extra money supply to be inflationary, you would need the velocity of money to pick up as well? So what is going to be the catalyst for this extra money supply to actually become inflationary? So far, there's been very little correlation between extra money supply and core inflation.
Yeah, well, I mean, I think if you look at, the chart you're referring to, if you look at it over a very long period of time, money supply growth and nominal GDP are very, very correlated. Now, if you try to break it down year by year over the short term, it doesn't look as correlated. And I suppose when you've seen a spike, the likes of which we've seen during the pandemic, it's hard to think that some of it won't go into the economy. But I suppose the real inflationary spark here is probably what consumers do with their savings. Look, if consumers massively save all their excess savings and keep it as savings, then there's probably less inflationary impulse. But if consumers spend a reasonable proportion of this, then it can filter into the economy very, very quickly. So I suppose this isn't why it's a science. This is a bit of an art form in many respects, because there are so many uncertainties about what the consumer will do now. For those on the inflationary side, we think the consumer will spend, and we think there is a lot of pent-up demand, and a lot of that excess forced savings out there will make it through into the economy. So look, I mean, in the last decade or so, you haven't had much inflation, even though you've had a lot of money printing, because a lot of the money printing hasn't ended up in the real economy. I think that's where this time might be different, that a lot of the excess savings will end up in the real economy, in our opinion.
So I actually agree with Deutsche Bank in their forecast here and their concerns. I share the same concerns. I do take one issue with one of the journalists there that we need velocity for this to really spike inflation. I've done videos in the past where I shared that velocity. This is the lowest velocity has been since 1946. And in 1946, the CPI rate was 19.65% or whatever it was. CPI is not correlated with velocity. We had relatively low velocity in the 1970s, yet we had high CPI. We had high velocity in the 1990s, yet we had low CPI. So CPI velocity is just, in my book, overrated. It's not to be discounted, but some people like Jim Rickards and others just think velocity is a be-all and end-all. I think it's actually lazy economics, and they need to look at the data on this. So anyway, I agree with them. Now, the Fed is risking a full-blown recession, says Bill Dudley, based on their inflation targeting regime. Now, just have a look at the summary of recent warnings in the housing market. As you guys know, I have shared in previous videos that I've been selling my cash flow real estate into this bull market. Now, some might think I'm crazy, and yes, I acknowledge that the housing market could continue to increase over the next little while. However, I like to buy things that are cheap and sell things when they're expensive. And while there's a market frenzy, I'm happy to offload and cash in and reinvest the proceeds of this into underpriced assets such as gold, silver miners, explorers, and other commodity producers. Now, in here you can see the US house price index, consumer sentiment versus builder sentiment. US house price to rent ratio, it's the highest it's ever been. US house price to rent ratio growth, plan to purchase a home is falling, and good time to buy a home is actually the lowest it's been since, well, 1981, 82. And household debt as a percentage of GDP, and Switzerland takes a gold medal, and Australia, good old Australia, takes a silver medal here. However, Australia takes the gold medal when it comes to debt to income, which is around 200%. Next week, I am going to do a video solely on the Aussie housing market and the Aussie economy and how I see things, because I've got a lot of Australian viewers to this channel, and some feel that I'm a bit US centric in this video. Look, the US is important. They're the largest economy. They're the US dollar is the reserve currency of the world, and so of course the US is vitally important to all of us. So yes, the US is the center of the global economy, in my opinion, even though there's a big push for China. And yeah, so I'm going to do a video on the Australian housing market and the Australian economy next week, which, look, for my viewers from other countries, you might find that interesting as well, because I think it's quite related to the US, to Canada, to New Zealand, the UK, Europe. So it's, yeah, hopefully you get a lot out of that. So the global central bank liquidity, whether it's the Fed, the RBA, and next week in that video that I focus on Australia, you'll be surprised at what the Australian Central Bank, the RBA, has actually done in terms of their balance sheet compared to all the other central banks around the world. But it really is the markets since the global financial crisis. Let's be honest, the markets have been driven by global central bank liquidity. And this is where Bill Dudley and others are thinking that the day of this is coming to an end very soon, and we are at the bottom of the interest rate cycle. If CPI inflation kicks off, then bond markets are going to react, and we're going to see yields rise, and central banks will be forced to lift rates. I don't know. They didn't do it in the 1940s, so I mean, at the end of the day, the problem that we're in right now is we have two options. We either default on the debt or we default on the currency. And I don't see politicians and central bankers choosing to default on the debt. I think they're going to default on the currency. They'll take that option before they take the other option, but I could be wrong. When we have a look at the M1, currency supply absolutely went vertical last year, and since then, it's still going up. Obviously not in the direction or the speed that it was, but it's still going up. And with Biden's, and it's not just Biden, it's every country, whether it's Australia, Canada, Europe, the fiscal spending, which is ultimately getting funded by the central bank through the dealer banks. And I know we can go through exactly how base money and broad money and all that sort of stuff works. And I've done videos in the past. I'm not going to get stuck on that. But ultimately, we are seeing this move to MMT, where basically the Treasury and the central bank almost become one. Also, what's interesting is that the short interest in the stock market is at 1.5%. This is the lowest since just before the dot-com bubble bursting. So, this is just another sign that financial markets, whether it's a stock market, real estate market, and I've said this before, the bond market is the biggest bubble in town. However, you do have central banks that are manipulating that big time, which is having a flow-on effect into other assets like the stock market and real estate market. But there's so many signs that the stock market is overvalued and is in a bit of trouble. I think the real estate market as well. But we'll see. Now, I keep coming back to this chart. If we think the macro picture is inflationary, and Dr. Michael Burry and Professor Richard Werner says that the currency is ultimately going to collapse. And if the currency is going to collapse due to hyperinflation, you want real assets, you want gold, silver, you want platinum, palladium, commodities, you want all of that. Dr. Michael Burry also says real estate with a caveat, with a question mark, because governments did do some things to real estate during those different inflationary periods in different jurisdictions throughout history. So he has a question mark over real estate as being an inflationary hedge, or a hyperinflationary hedge, should I say. But all those other things are. And stocks aren't. Stocks just aren't an inflationary hedge. Don't forget, in 1973-74, we had the stock market actually fall by 50% in nominal terms, not adjusted for inflation, in nominal terms. So and I think inflation, or CPI, during that period was about 12.5%, something like that. So yeah, if we think the macro outlook, and like I said in this video, so many deflationists are now jumping on the inflation bandwagon, warning that the Rubicon is being crossed, that this is something now to be concerned and worried about. I think it's worth hedging your portfolio against this. And at the moment, commodities, gold, silver, explorers, miners, all that are still undervalued in my opinion. Now, this isn't financial advice, but anyway, that's just my opinion. What do you guys think? Love to see your thoughts and opinions in the comments below. Don't forget, hit that like button if you like this video. Please hit that like button. Apparently it really, really helps the algorithms and whatnot. So, appreciate that, guys. Anyway, take care, and I'll see you again on another episode of Finance Uncut.